Welcome to the deep dive. We are here to take these complex, sometimes really intimidating stacks of sources,
Absolutely.
in this case, all centered on U.S. tax code and regulatory compliance, and just distill them into the most essential, actionable knowledge for you.
Our mission today is all about the money that the government doesn't tax you on when you sell an asset. We're decoding that core mechanism, the one that separates your true profit from just getting your original investment back.
And that mechanism is the absolute foundation of calculating capital gains. It's called cost basis.
That's the one.
For anyone who's ever, just stared blankly at a Form 1099-B or maybe tried to figure out the tax hit for selling inherited property, this deep dive is for you. It's your shortcut to being profoundly well-informed.
We're going to unpack the three fundamental ways that basis is determined, how it can change over time, and the massive legislative shift that basically forced financial institutions to start tracking all of this for you.
Right, a huge change. It really requires us to navigate some specific sections of the Internal Revenue Code and those pivotal changes from 2008.
Yeah, that act redefined the whole relationship between the investor, their broker, and the IRS.
So let's start at the very beginning. Let's define the subject in the simplest terms, using an analogy from our sources. Let's talk about the rock business.
Okay, the rock business. Imagine you buy a rock for, say, $20.
A very valuable rock, apparently.
A very valuable rock. That $20 is your initial investment. That's your cost basis. Now, if you turn around and sell it later for exactly $20, you've made no profit.
No profit, so no taxes due.
Zero tax. That $20 is like your cost of goods sold. You have to get that back before there's any actual gain.
Okay, but what if the market for this rock goes crazy?
Well, let's say you sell it for $25. The critical calculation is that difference. The $25 you got from the sale minus your $20 cost basis.
Leaves you with $5.
Exactly. A $5 capital gain. That's the part that's subject to capital gains tax, not the whole $25, just the $5.
That initial $20 purchase price is the essential starting point.
It is.
So, to make sure we've got the full picture, let's bring in the formal language.
Right.
What does the IRS, specifically in Publication 551, have to say about this?
Well, the official definition is that basis is the amount of your investment in property for tax purposes. But, and this is important, it's not just about sales.
Right.
The IRS specifies you use basis to figure out things like depreciation, amortization, depletion, casualty losses, and then, critically, gain or loss on the sale of property.
That's a crucial distinction. It's not just about your stocks.
Wow.
When they mention amortization and depletion, that pulls in some very specific asset classes that rely entirely on basis for how they're taxed.
Precisely. Depreciation is for tangible things, like a building or equipment. Amortization is for intangible assets.
Like patents, copyrights, things like that.
Exactly. Patents, software, even the cost of setting up a business.
Right.
And depletion, that's reserved for natural resources.
So oil wells, mines.
You got it. It lets the owner recover the cost of that resource as it's extracted. But the common thread through all of these is that the basis defines the limit.
Yeah.
It's the limit of what you can deduct, and it's what you use to figure out what you eventually have to pay tax on.
So it really underpins the entire structure of how wealth is calculated in the U.S. tax system.
It absolutely does.
Okay, let's unpack how we figure out that initial starting line. We've established basis is the core measurement,
Right.
but the sources are clear. It's not always just what you paid for it. The basis depends entirely on how you got the asset in the first place.
That's the key complexity right there. The tax code is really designed to track capital consistently, so the history of an asset, it follows the asset. Doesn't matter who owns it now.
Let's start with the path most of us run into, the simple transaction.
Okay, path 1. Assets acquired by purchase or contract. This is governed by IRC Section 1012, and it's the simplest case. The basis is just the purchase price.
So it includes everything.
Everything necessary to acquire the asset. The price, sales tax, settlement costs if it's real estate. So if you bought that rock for $20 and paid $2 for shipping,
Your basis is $22.
$22. Simple, straightforward, easy to document.
Now we get into the area that starts to tie the new owner to the old owner's history. Let's talk about gifts.
Right. Path 2. Assets acquired by gift or trust. This is under IRC Section 1015, And it introduces this really complex idea of the carryover rule.
Also called a transferred basis, I see.
Exactly. And the general rule is, well, it's non-negotiable. If you get an asset as a gift, you also get the donor's original adjusted basis. It just carries over to you.
Okay, let's use a real example here to make this stick. Let's say my aunt bought 1,000 shares of a company, say, 50 years ago for $5 a share.
So $5,000 total basis.
Right. And today, those shares are worth $100,000. If she gifts them to me, what is my basis?
Your basis is her original basis, $5,000.
Not the 100,000.
Nope. The $95,000 of appreciation that built up while she owned it, that's unrealized gain. The fair market value at the time of the transfer is, for calculating your gain, completely irrelevant.
Why do they do it that way?
The whole point of the carryover rule is to make sure that unrealized gain doesn't just disappear. It will eventually be taxed when you finally sell those shares.
So if I sell them tomorrow for $100,000, I suddenly realize a $95,000 capital gain, and I'm the one paying the tax on it.
Yes. Your aunt essentially transferred her potential tax bill to you right along with the shares.
Wow.
But, and this is a huge but, the rule gets dramatically different if the asset has lost value.
This is the loss exception, and this is where the sources say it gets really interesting because the asset can suddenly have two different bases.
Correct. If the donor's basis is more than the fair market value when they give it to you, so it's worth less than what they paid, the dual basis calculation kicks in.
Okay, let's walk through the numbers on this. Let's say my uncle bought a stock for $10,000.
Okay.
When he gifts it to me, its market value is only $6,000. So he's handing me a built-in loss of $4,000.
Right. And under this loss exception, your basis actually depends on what you sell it for, whether you sell it at a gain or a loss.
So what's my basis for calculating a gain if I sell it for more than he paid?
For calculating a gain, it's still the donor's basis, the original $10,000. If you sell it for, say, $12,000, you use that $10,000 basis and you have a $2,000 gain.
Okay, simple enough. But what if I sell it for a loss? Let's say I sell it for $5,000.
Now you have to switch. For calculating a loss, you must use the lower basis, which is the fair market value at the time of the gift.
So $6,000.
The $6,000. So if you sell for $5,000, your realized loss is only $1,000. The critical thing here is you cannot use his original $10,000 basis to claim a $5,000 loss on your tax return.
Why is it structured like that? It seems incredibly complex.
It's an anti-abuse rule.
Yeah.
Think about it. Without it, someone in a high tax bracket could buy a stock, watch it go down, and then just gift that loss to a relative who needs to offset some big gains.
I see. So you can't just pass around tax losses like that.
Exactly. This forces the person who gets the gift to use the lower value, which prevents them from using the donor's pre-gift drop in value as their own tax deduction.
And what if I sell it somewhere in the middle, between the $6,000 and the $10,000?
Then you realize neither a gain nor a loss. It's a wash. It's a very sophisticated rule that really requires the person receiving the gift to track two separate basis numbers.
That complexity really highlights why we need to do this deep dive. Okay, let's move to the third path, which is often the most financially advantageous for the person receiving the assets: inheritance.
Path 3. Assets acquired by inheritance. This is IRC Section 1014, and it's the legal mechanism behind the famous stepped-up basis.
The mechanism here sounds pretty straightforward, but the tax implication is just immense.
Oh, it's huge. The mechanism is this. Assets you inherit get a basis equal to the fair market value of that asset on the date of the decedent's death.
So the original cost is just gone.
It's completely disregarded, wiped clean.
So let's go back to my aunt's stock. She bought it for $5,000. She holds it her whole life. At her death, it's worth $100,000. I inherit it. What's my basis?
Your basis is $100,000. This is the major aha moment in tax planning.
Wow.
That $95,000 of appreciation that happened during her entire lifetime, it's completely shielded from any income taxation. It just vanishes for income tax purposes anyway.
So if I sell that stock the very next day for $100,000, my gain is zero.
Zero gains, zero capital gains tax.
Incredible.
And that's exactly why the way an asset is transferred gift versus inheritance is maybe the single most crucial question in estate planning for appreciated assets.
It's a powerful tool for generational wealth transfer.
It is, but it also sits at the center of a lot of political and economic debate about tax fairness because it lets so much appreciation bypass the income tax system entirely.
It really highlights that the tax you pay isn't determined by the money you made, but by the paperwork. whether it says gift or inheritance.
So now we have our initial starting basis. But as the source material really stresses, that basis is rarely static. It's a dynamic number that changes over the time you hold the asset.
Right. To compute your final taxable gain, you need to take the sale price minus the adjusted basis. That's from IRC section 1001A. So the original basis is just the foundation. The adjusted basis is like the running tally of your total investment.
That's a great way to put it. The adjusted basis goes up when you put more capital into the asset, and it goes down when you recover some of that capital through deductions.
Let's stick with the sources metaphor here because I find it really helpful. Viewing the asset as a kind of savings account. What are the deposits that would increase the asset's basis?
The primary deposits are capital improvements, and these have to meet a pretty high bar. They have to substantially prolong the useful life of the asset or significantly increase its value or, adapt it to a new use.
So just repairing something doesn't count.
No, a repair is a current expense.
Sure.
So for a rental home, painting the walls or fixing a leaky faucet, that's a repair. You deduct it now.
But adding a whole second story or replacing the entire roof structure, those are improvements.
Exactly. Those are capital improvement. So if you bought that rental property for $300,000 and you spent $50,000 on a major capital improvement, your adjusted basis is now $350,000.
And when I sell, the IRS acknowledges my total economic investment is now higher.
Right. You're only taxed on the gain above that new higher number.
Okay, now for the withdrawals from this basis savings account, what diminishes it?
The main withdrawal is the depreciation deduction. Depreciation is a mechanism that lets you recover the cost of an asset minus the land value. You can't depreciate land over its useful life. It's a statutory deduction that lowers your current taxable income.
And that's a really powerful immediate tax benefit. If I take a $10,000 depreciation deduction this year, my taxable income is $10,000 lower. But what does that do to the asset's basis?
It reduces it, dollar for dollar. So if your basis was $350,000 and you've taken $50,000 in depreciation over 5 years, your current adjusted basis is now $300,000.
Because I've already recovered $50,000 of my investment through those tax savings.
Precisely.
Let's run through a full example for a rental property just to really drive this home.
Okay, let's say you have an initial basis of $400,000, not counting the land. In year one, you spend $25,000 on a major kitchen remodel.
A capital improvement. So my basis is now $425,000.
Correct. Then, over the next 5 years, you take $50,000 in accumulated depreciation deductions. The basis drops now to $375,000.
So if I then sell the property for $500,000, my gain is not the simple $100,000 difference from my original purchase.
No. Your taxable gain is the $500,000 sale price minus your adjusted basis of $375,000. That's a $125,000 gain.
And that extra $25,000 of gain is a perfect match for the depreciation I already deducted.
Exactly. The tax code is making you pay back the tax benefit you got up front. We often call this depreciation recapture when the asset is sold.
And we should just briefly touch on the other basis reductions the IRS mentioned, amortization and depletion.
Right. They work the same way. Amortization reduces the basis of intangible assets, like a patent. Depletion reduces the basis of natural resources, like a mine.
So in every case, the rule is the same.
The same. The reduction in your current taxable income comes with a matching reduction in the asset's basis, which guarantees a larger gain when you eventually sell.
It's a really profound link between those short-term deductions and your long-term capital gains liability. And this moving target of adjusted basis gets really critical when we start talking about investments.
This is where basis tracking stops being about houses and decks, and it starts becoming a real accounting headache.
Right. The complexity explodes when you buy the same security multiple times at different prices. You end up with different purchase lots.
And you need a legally recognized way to decide which lot you just sold.
Yeah, if I buy 100 shares of a mutual fund at $10, then 100 more at $15, and then I sell 50 shares, which ones did I sell? The $10 ones, which maximizes my gain, or the $15 ones, which minimizes it?
That ambiguity is exactly why the IRS in Publication 564 had to approve specific methodologies. We can group them into two types: cost-basis methods, which track individual lots, and average-basis methods.
Let's start with the cost-basis methods.
The first is specific share identification, or spec ID. This is the one that gives you, the taxpayer, maximum control. It means you or your broker has to track every single purchased lot.
And I have to explicitly tell my broker which shares to sell.
At the time of the sale, yes. You have to say, sell 50 shares from the lot I bought on June 1st. It's very surgical.
And the second cost basis method.
That's the default. First in, first out, or FIFO. If you don't say anything, this is what the broker has to use. It just assumes the oldest shares you bought, the first ones in, or the first ones you sell.
The first one's out. And as we'll get into later, FIFO is usually the least tax-efficient method.
It often is, yes.
Yeah.
Now, moving to the average basis methods. These were really created for mutual funds because of all the dividend reinvestments and fractional shares.
So the third method is average cost single category, or ACSC.
Right. ACSC simplifies everything dramatically. All your purchases, no matter the price or date, they get pooled into one big category. You just divide the total money you've spent by the total shares you own.
And you get one single average cost per share.
One single average. Every time you sell, you use that cost. It makes for simple record keeping and usually a moderate tax bill. It basically gets rid of the whole lot history problem.
Okay, now the fourth method, which our sources mention, is average cost double category, or ACDC. This seems like a more advanced version.
It is. It's a crucial distinction for more sophisticated investors.
How does ACDC differ from the single category version?
ACDC keeps the simplicity of averaging, but it separates your holdings based on how long you've had them. It splits everything into two buckets. Shares held for 1 year or less, which is short term.
And shares held for more than 1 year, long term.
Right.
Why is that separation so strategically important?
It's all about the tax rates. Short-term gains are taxed at your ordinary income rate, which can be as high as 37%. Long-term gains get much lower, preferential rates 0, 15, or 20%.
I see.
By splitting the cost bases into two categories, you can tell your broker to sell shares from the long-term category first. This ensures your gains are taxed at that lower rate. It gives you a strategic flexibility that the single category method just doesn't have.
So you get the simple averaging structure, but you still have a critical lever, the holding period, to manage your tax rate. That's a key piece of the plumbing for mutual funds.
You know, for decades, these methods existed, but the burden of actually tracking the cost basis, it fell almost entirely on the individual investor.
You had to keep every single trade confirmation slip in a shoebox for 40 years.
You really did. The brokers were not required to track your adjusted basis and report it to the IRS.
That historical context is so important because it sets the stage for this massive pivotal change we're calling the reporting revolution. And that all started in 2008.
It did. The change came from the Emergency Economic Stabilization Act of 2008. Most people know it as the bailout bill.
Right, signed in the middle of the financial crisis.
And while most of the bill was about stabilizing markets, there was this one section, Section 403, that contained provisions that just fundamentally reshaped financial compliance.
And that's the mandate that made cost-basis reporting mandatory.
Yes. Suddenly, intermediaries, brokers, banks, fund companies, they were all legally required to calculate and report accurate, adjusted cost basis information. Not just to their clients, but directly to the IRS on Form 1099-B.
That must have been a massive undertaking for the financial industry.
A costly, complex, and revolutionary one. And the implementation wasn't instant. The IRS knew this would be a huge IT overhaul, so they phased it in.
Based on the complexity of the asset, and these dates define what we now call a covered security.
Right. A covered security is one the broker must track for you. And the clock started ticking first for the simplest assets, equities acquired on or after January 1st, 2011.
So if you bought stocks after that date, your broker became the mandatory keeper of your basis data.
Exactly. Then the next year, the complex averaging rules came into play. So mutual fund and dividend reinvestment plan shares acquired on or after January 1st, 2012.
That forced them to handle all the fractional shares and everything else.
Everything. And finally, the most technically challenging instruments were added. So things like debt securities, bonds, options, private placements, acquired on or after January 1st, 2014.
So this comprehensive rollout means basically every widely held investment you've thought in the last decade or so is now tracked and reported for you.
It is, which has eased the compliance burden for the average person dramatically.
So after 2012, what are the absolute non-negotiable requirements for a broker? What methods do they have to offer you for these covered shares?
The law is very specific on this. They have to offer at least 3 methods.
Okay.
Specific share identification, spec ID, first in, first out, FIFO, and average cost single category, ACSC. The availability of these strategic options is a key part of the law.
And the gravity of this, the need for compliance, I mean, the penalties have to reflect that. What happens if they fail?
The financial risk for the brokers is huge. They face penalties up to $350,000 per year just for inaccurate 1099-B reporting errors.
And if it's deliberate.
If the IRS determines it was intentional disregard of the new rules, those penalties become unlimited.
Wow.
It's why compliance departments treat basis reporting with extreme urgency.
And the taxpayer isn't off the hook either, right?
Not at all. You can face a penalty of up to $1,000 for underreporting your capital gains, and it can go up to $5,000 for willful disregard or reckless conduct. The new system creates a paper trail that makes it really easy for the IRS's computers to spot a mismatch.
Now let's talk about one of the most technical but important parts of this. What happens when you move an account, the transfer rule?
Right. If you move your account from broker A to broker B, broker A has to provide all the necessary cost basis information to broker B within 15 days of the transfer.
So there are no gaps in the history.
Exactly. And the nature of that transfer is critical. Our sources make a point about not sending a rolled-up total cost. Why is that forbidden?
Well, it's forbidden because all those strategic options we discussed, like Spec ID and FIFO, they depend on the lot history. You have to know when each specific share was bought and for how much.
I see.
So institutions have to transfer the full lot history, the date, the price, the number of shares for every single lot. If broker A just sent a single total cost number, broker B couldn't apply FIFO or Spec ID correctly.
It would legally hamstring the investor's tax strategy.
It would. And to manage all this data, the industry came up with a solution, right?
They did. Many institutions now use the Cost Basis Reporting System, or CBRS. It's an industry standard for formatting and transmitting this data electronically. It ensures the data can move cleanly and that full lot history is preserved.
So the compliance burden really has shifted entirely from your shoebox in the closet to the secure digital infrastructure of these big financial institutions.
It has, but that infrastructure has to be capable of moving decades of super granular data within a 2-week window. It's a logistical marvel driven by a regulatory imperative.
So we've laid out the rules, the definitions, the whole regulatory environment. Now we get to the strategic part. How you, the taxpayer, can use these mandated methods to minimize your final tax bill.
This is where knowledge directly translates into preserved capital. The choice of method is arguably the most controllable part of the whole equation, as long as you have multiple purchase lots.
It dictates the timing and the size of your taxable event. Let's start with the one that takes the most effort but delivers the biggest return. Spec ID.
Right. Specific share identification. It gives you almost total discretion. You can cherry pick which shares you sell.
Which lets you do two things: tax loss harvesting and gain minimization.
Exactly. For gain minimization, you tell your broker to sell the lots with the highest cost basis. That creates the smallest possible capital gain.
And for tax loss harvesting.
You can surgically select lots that are currently underwater, worth less than you paid, to realize a capital loss. And that loss can then offset other gains you have, and even up to $3,000 of your ordinary income each year.
It's the ultimate control mechanism. But the sources noted a really crucial administrative change to Spec ID that started in 2012. You have to be proactive now.
That is so important. You have to identify the shares being sold at the time of the sale. You can't sell 100 shares in May and then wait until December to retroactively decide which lot they came from to optimize your taxes. It has to be contemporaneous.
Good to know. Okay, next up is the default setting, which usually works against you if you're trying to minimize tax. FIFO.
First in, first out. If you do nothing, this is what you get. The broker sells your oldest shares first.
And why does that almost always result in the highest tax bill?
It's just the principle of long-term appreciation. A stock you bought 20 years ago is very likely to have the lowest basis compared to today's price.
So when you sell that oldest lot first, you're maximizing the spread between the sale price and the cost basis.
Which maximizes your taxable gain. For long-term investors, FIFO is usually the one to avoid.
So if you want the exact opposite of FIFO, you turn to HIFO.
Highest in, first out. HIFO is designed for strategic gain deferral. It dictates selling the shares with the highest cost basis first. By definition, those are your least appreciated lots.
Let's use a quick numerical example to really solidify the difference here.
Good idea.
Let's say I want to sell 100 shares at $40 a share, so I'm getting $4,000. And I have 3 lots I could sell from. Lot A, bought at $10 a share. Lot B, bought at $20. And Lot C, bought at $30.
Okay, so 3 different cost bases. If you use FIFO, the default, you sell Lot A, the oldest one.
So my gain is $4,000 minus the $1,000 basis for Lot A, a $3,000 taxable gain.
$3,000 gain. Now, if you use HIFO or you just use Spec ID to pick the highest cost lot, you sell Lot C,
In that case, my gain is $4,000 minus the $3,000 basis for Lot C.
which is a $1,000 taxable gain.
So the strategic choice right there results in $2,000 less in taxable income recognized immediately. That is incredibly powerful.
It's a huge difference.
Now let's get into the two methods that are less about cost and more about the type of gain, which connects to tax rates: min tax and max gain.
Right. Min tax is a codified strategy for optimizing your tax outcome, especially when you have both short-term and long-term holdings.
To understand min tax, we should probably do a quick refresher on the tax difference between short-term and long-term.
Absolutely. A short-term gain is from an asset you held for 1 year or less. It's taxed at your ordinary income rate, which can be high.
And a long-term gain is from an asset held more than 1 year, taxed at those lower preferential rates.
And the min tax strategy just prioritizes selling the lowest tax items first.
What's the specific order?
The min tax sale order is, first, short-term losses,
To offset those high-rate gains?
then long-term losses, then long-term gains because they're taxed at lower rates, and dead last are short-term gains because they're taxed at the highest rates.
So that structure is purely designed to minimize your current tax bill.
It is. And then, finally, you have its conceptual opposite, max gain.
Which seems like something you'd rarely want to do.
It is rare, but it confirms the flexibility of the system. Max gain just flips the min tax order. It prioritizes realizing short-term gains first. It maximizes your immediate taxable income.
Maybe if you think your tax rate is going to be much higher next year.
That's really the only scenario. But the key takeaway here is that the law now requires brokers to give you the tools for this kind of sophisticated tax planning. You have control far beyond the old default of FIFO. The shift to mandatory reporting in 2012 didn't just affect the brokers. It also fundamentally streamlined the process for the taxpayer when they wanted to use these different methods.
Right. Before 2012, changing your basis method, especially for mutual funds, was a serious bureaucratic process.
Oh, it was a headache. You had to formally petition the IRS and get their approval just to change your accounting method.
And starting in 2012,
That requirement was eliminated. You no longer have to petition the IRS to switch your cost basis method, as long as your brokerage firm supports the method you want to use.
that made the strategic choices we just discussed so much more accessible. But there's a crucial formality that's still in place when you're dealing with the average cost method.
This is an absolutely critical point for everyone listening, the in-writing requirement. To move into or out of the average cost method, you have to make that election in writing.
And the IRS is pretty strict on what in writing actually means, what's acceptable.
Acceptable forms are things like a physical letter you mail to the financial institution, changing the method online through their secure portal, or filling out a formal signed election form.
The key is a paper trail.
An indisputable paper trail or a verifiable electronic record of your intent.
And what about things that might feel official but the IRS rejects?
The big one is verbal permission on a recorded line. The IRS does not currently consider that to satisfy the in-writing requirement.
So even if the call center records the call and says, okay, we've changed it for you, that's not good enough.
It's not sufficient documentation in the eyes of the IRS. If you want to use average cost, you have to submit a written or electronic request.
That is a crucial administrative detail that could trip up a lot of people. You need that digital confirmation or the physical paper.
Exactly. This high level of documentation just reinforces how serious this regulatory shift was. The IRS wants clear, audible records for anything that determines the size of a taxable gain.
And this all circles back to the transfer rules, too.
It does. As we mentioned, when an account is transferred, the full lot history has to move with it within 15 days.
And just to reiterate, they can't just send a rolled up total cost.
No, because that would destroy your ability to use FIFO or Spec ID. That granularity has to be maintained for all your covered shares so that your new broker has the exact same data your old broker had.
The whole system post-2012 is really built on this premise that the financial intermediary is the mandatory, accurate keeper of all this granular data.
It frees the investor from holding paper receipts, but it binds the institutions to a very, very high level of compliance. So we've traveled all the way from the simplest definition of profit to the really complex regulatory plumbing of major financial institutions.
Yeah. To synthesize, we really focused on those three major paths for determining your basis. By purchase, which is just the price you paid.
By gift, which is the donor's carryover basis with that tricky loss exception.
And by inheritance with the profoundly beneficial stepped-up basis.
Then we detailed how that basis is actively managed. It becomes an adjusted basis.
Right. Capital improvements are like deposits, and depreciation deductions are like statutory withdrawals.
And we saw the highly strategic flexibility you now have with methods like Spec ID and HIFO, which let you override that high tax default of FIFO.
Understanding cost basis is just fundamental. It's the only mechanism the tax code uses to measure your true economic gain.
Which is your ability to realize capital without paying unnecessary tax.
And this brings us back to that fascinating tension we discussed when you view an assets-adjusted basis as a kind of savings account.
We established that depreciation is a statutory withdrawal. It reduces your basis, and it gives you an immediate tax deduction against your current income.
But that action guarantees a larger potential capital gain down the road because your basis is now lower. So you have an immediate benefit versus a deferred, magnified liability.
Now here's the juxtaposition. That liability, which you build up over years of taking those deductions, is completely wiped clean if the asset is held until death and then transferred to an heir under the stepped-up basis rule.
The accumulated unrealized gain, much of it caused by those basis reductions from depreciation, it just vanishes from the income tax ledger forever.
So the question for you to mull over is this. What implications does this imbalance have on long-term capital planning? The immediate tax benefit of depreciation is allowed to stand, but the corresponding deferred liability. It may never be collected because of the stepped-up basis rule.
It's a powerful structural mechanism. It really rewards holding depreciated assets until death.
And it influences that ongoing political and economic debate around whether we should modify or maybe even eliminate the stepped-up basis rule entirely.
Knowledge is power, especially when that knowledge can save you thousands in capital gains liability. Thank you for joining us for this deep dive.